26 years of CNBC TV 18.
Hello and welcome to MF Corner. I'm Sonal Bhutra. With me, as always, is Vinnii Motiwala. Vinnii, good afternoon. And we are already towards the year end. Can you imagine? Time flies. But the fact is, what we've done for you is talk about the funds which have done well or not done so well this year. We'll analyze it for you. But of course, you have done the analysis, the research, the data. All of that will be put together and we'll discuss it with a guest today, Vinnii.
Absolutely. That's what we're going to be doing, right? Like some of the funds which we've picked out and which have outperformed is mainly a 1 year, 1.5 year data because they've been launched in the recent times, right? So yes, normally we do not look at just 1 year return. You wait out for the longer period of time. But this is still to understand from a viewer's point of view. Is it the right fund to hold on to? Is it not? And what is it that is making a difference in that particular space for each of these funds? So we'll be discussing all of that. And to talk to us about that, we do have a guest joining us this afternoon as well. We have Nirav, Karkera, Head of Research at Fisdom. Nirav, good afternoon. Thank you so much for joining us on the show. You know, we have divided into 3 parts: equity, mid-cap funds, small-cap funds, as well as the hybrid funds, which have been, the buzzwords or the trends that everyone wants to understand and analyze on. So, Nirav, let's start with the equity mid-cap funds first. In that, now we have picked out a few of these names, whether you look at the Invesco India Fund, which is an India mid-cap fund that we're going to be talking about. When you look at that, that's been an outperformer when you look at it from a 1 year point of view. 13-14% return versus other categories or other funds in that category. Now, could you highlight what is it that has led to the outperformance? What is the differentiating factor for this one versus others? Even 3-year return has been relatively good versus other funds.
So, Vinnii, almost a year back or so, this is a fund that really came up on our radar as well. It was really turning around the corner. And this is one of the fewest funds that, most would appreciate is a very true to label mid-cap fund. So often you'll notice many mid-cap funds also utilize their flexibility to take large-cap exposures. But this one here is a true to label mid-cap fund, which ensures that when you invest in it, what you see is what you get. So this is one thing that we absolutely loved about the fund. And there are a few things that really helps it stand apart, of course, besides the performance. In fact, what matters is the process that goes into managing the fund that finally leads up to the performance. So this is out and out bottom-up picked portfolio. Okay, so it does not rely on themes. It does not rely on narratives. There are no sectoral calls at play here. It is a pure play bottom-up stock picking strategy, and any sectoral composition that you see, often than not, it is a byproduct of the selection, and it is not the starting point of the selection in this fund. This fund has been able to identify winners in essentially crowded segments like financials, right? Every fund has financials. Now, how do you pick the best financials, especially in the mid-cap segment? So this fund has an answer to it. They have been very astute with their picking. Even in tricky segments like healthcare and industrials, these guys have been able to pick the key movers and shakers well ahead of time. So they do not have any style bias. They are pure bottom up. You look at a few picks, right? You look at L&T Finance, AU Small Finance Bank, these two on the banking and financial service side. Even in, on the realty side, Godrej Properties, a name that most people overlooked also because real estate is an often overlooked sector and under-owned sector by mutual funds specifically. The fund went ahead and bought into it. Some of these picks have really helped prop up the returns. Even in defense, it is not buying the entire pack. Selective names like Bharat Defense has been really instrumental in driving the return. So what's working for the fund is very specifically the bottom-up stock picking strategy, which of course considers sectoral headwinds or tailwinds, but does not make it the premise for selection.
Yes, so the mid-cap index up 4% this year, and this index, this particular fund is up around 14%. So that is the kind of return this fund has given back to the investors. And as you pointed out, a pure play mid-cap fund and is using the bottom-up approach. Individual names and individual stocks is what they are highlighting and focusing on. The next one, which has underperformed this year the most, Nirav, has to be the Motilal Oswal mid-cap fund. The 1-year performance, of course, is lower, but on a 3-year basis, they've done well. It's a 25% return for any investor. What do you think went wrong here this time? Was it an active churn that the fund manager took? And over a longer period of time, how do you view this particular fund?
So let me be honest, this year has not been particularly great for the fund, but I'll probably go out on a limb, stick my neck out and say this still is one of the very good funds that one must look at closely or at least track going forward. So it follows a very high conviction, concentrated fund management strategy. Okay, so it is not too diversified, not too many holdings. It just builds a bottom up basket of stocks, and it tries to ride out the entire tide. Of course, what did not work for it last year is a different story. I'll come to it in a bit. But one thing that one must understand about this fund, characteristically, this is a hard hit or a hard miss play. Okay, so when cycles align, when the themes align, this fund is set to hit the ball out of the park. But like what we saw in the last year, if the cycle doesn't align, if the themes don't align with the high conviction bets, this fund will probably be among the first ones to be walking out of the park. Right. So in this fund, what really did not work out is their philosophy of going overweight on certain themes like premium consumption, engineering services, mid-cap IT services. So these are plays where the conviction was very high. It still continues to be very high. And the selection is through a pure bottom-up approach, but this did not play out in the last year. There were a few isolated bets that were taken in the financials and defense segments that did really well, but the weightages and the exposures here were not big enough to pull it out of the trenches as such, right? It continued to underperform because of the larger themes and the overweight themes in the portfolio facing a lot of headwind. So this year alone, these themes did not play out, but there's nothing to say that it won't play out in the medium term. This is a high conviction play. Whenever the cycle turns and the theme and cycle aligns, this will definitely be at least among the top contenders to lead the top of the table. So it is characteristically an aggressive, high conviction, concentrated play.
Nirav, let's shift focus now and talk about the equity small cap fund as well. We've picked out 3 funds here. So the first 2 being outperformers, that is Invesco as well as Quant, the small cap funds there. The underperformer we're going to be talking about is DSP. Now, Invesco, obviously the name came in even on the outperform side of the mid-cap fund as well. The small cap fund that we're talking about, Invesco small cap fund for the company, 1-year return has been 2.25%. 3 years return, good, 24%. Overall, your fund analysis, what are we keeping an eye out on? And is this a similar strategy that one could see continuing how we saw in the mid-cap fund as well?
So, like I also said at the mid cap, right? So, this is something that runs through the small cap strategy also. Rigorous research first, bottom up stock picking is at play here as well. Just very similar to the mid cap strategy. Oh, here the portfolio may be slightly more diversified as it should rightfully be, considering that the small cap segment is quite a fragmented segment with opportunities and pockets of opportunities being largely spread across the market cap, right, within the small cap basket itself. So, fairly diversified portfolio for risk management, it is a good thing. The fund, while it of course has a quality overlay, right, but most small cap funds try to over index on the quality factor. So, this fund here, what we clearly see is they have a knack for identifying stocks and companies that qualify on factors well beyond quality as well, right? So we see several picks that have done really well in terms of earnings revisions. In fact, they are very conscious, which is apparent from the portfolio construct, about the margin of safety when it comes to valuation. We all know that within small caps, the entire debate between value traps and value opportunities is a big dilemma. So these guys have been on the right side of things when it comes to margin of safety in valuation terms, but it has also been able to pick stocks that has fared really well in factorial terms and durability of growth momentum. It has been able to participate in some of these factors as well. And so if you see, the portfolio has a very distinct construct and very low overlap versus most other small cap funds. So most other actively small cap funds, you'll see them cluster around a select set of stocks. Here you'll see some very good distinction and flavor that the fund management management team has brought to the table. It has played some stellar bets in niche segments like capital markets, infrastructures, hospitals, very specifically. That has played out phenomenally well and has accrued in terms of performance also. So these are niche segments which they played fantastically well. Of course, even here it is not a segmental or a sectoral call. It is a bottom-up picking that is then reflected in terms of sectoral allocation. So it clearly has a multifactorial mix, and it clearly has a very good stock as well as style diversity, but it is not as if that's the starting point. The starting point still remains to be bottom up stock picking, and that is what sets this fund apart. And there's good reason to believe that this could sustain into the future as well.
Take that point. While we have spoken about an outperformer, let's look at the underperformer as well, Nirav. DSP Nifty Small Cap Quality 50 Index Fund, which is down 12% this year. What do you make of this one? What went wrong, if you can tell us quickly?
See, one thing you got to understand, it's a passive index proposition. It is a rule-based proposition, okay? It filters out hard metrics like ROE, earnings durability, consistency, etc. So it's a tight portfolio of 50 stocks screened only basis quality. Now, within the small cap segments, different factors play out at different points in time, and a single rule-based, single factor-based formula may not work across all cycles. And the lack of any human overlay takes away a lot of flexibility. So this is a pretty rigid formula-driven structure. Its performance will be very lumpy. It will work only when quality starts performing in a broad-based manner. Till then, it will continue to underperform. There's very limited reason to believe that it will outperform in any other cycle.
Okay. Thanks for the view there coming in on this fund as well. That was on the small cap fund and mid cap fund that we've covered. On that note, we're actually going to slip into a very short break. After the break, we'll talk about hybrid funds and what they have done and which ones that we're highlighting for you all as well. So stay tuned in for that.
"26 years of 26 years of CNBC TV 18.
Welcome back. You're still tuned into MF Corner. We still have with us Nirav Karkera, Head of Research, Fisdom. And today we are analyzing and discussing the underperformers and outperformers in certain categories through the year. Nirav, multi-assets or hybrid multi-asset funds, this is one category that did see a lot of traction this year. So let's talk about an outperformer here. A particular AMC we don't discuss too much, but has seen good returns this time around. So if we look at Mahindra Manulife Multi-Asset Allocation Fund, it has seen a one-year return of 19%. Of course, it was launched just back in 2024 March, so we do not have a longer period performance there. But 19% in this year itself, do you think it's only because of the fact that this particular segment did really well, or there was something specific that the fund manager did here?
So this is a very interesting and peculiar case because this fund has indeed performed very well. But this is a multi-asset fund, right? And the category has done phenomenally well, majorly on the back of exposure to precious metals. We all know that gold and silver have topped the charts across asset classes globally, right? And this is what has helped most multi-asset funds. But this fund particularly has relatively very low exposure to gold and silver as precious metals. Okay, so the fund has particularly accrued most of its returns through very deft management of their equity exposure, despite being a multi-asset fund and despite the fact that it missed out on quite a bit of the gold and silver rally by not fully exposing itself to those precious metals as much as the mandate allowed. They still managed to deliver very good performance. So that goes a long way to say about their equity fund management skills as well, right? So even in very tricky sectors like real estate and pharma, they've been able to pick stocks that have delivered very good returns. So it's not as if the entire pack did well, but their holdings were very well managed. In select segments like financials and auto, they were able to select a handful of stocks that did really well along with the sectors itself. So highly selective picks in the equity segment is what led to a lot of success. they also use their flexibility to move to lower into the market cap segment. So while it has a 60-65% sort of equity exposure, it even within equity it has roughly around 15 odd percent into mid cap names. So which goes on to reflect their stock picking abilities, and of course within the mid cap segment, it is more visible that it is a bottom up stock selection process at play and not as much a thematic selection. So several plays worked out really well, right from ICICI Bank, HDFC Bank, Britannia that it held, L&T Finance, one of the winners it had in its portfolio. So surprising enough, despite not really exposing itself to precious metals that did wonderfully well, this multi-asset fund managed to do well largely on the back of their equity selection, which is in fact a tougher job to do when precious metals were on a tear.
Absolutely. That's very, very interesting here. But even in the hybrid category, the underperformer is not giving negative returns. We're going to talk about Edelweiss multi-asset allocation fund next. That one also, this hybrid category as a whole has given positive returns. And the Edelweiss fund has given almost 7 to 8% return in the last 1 year. Obviously, the fund was also launched pretty recently in times of around 2023, June 2023, when this fund was launched. Nirav, your thoughts for Edelweiss, the multi-asset allocation fund. What was different here? Did they not have exposure to gold, silver? What didn't work out for them?
So there are a few things. So one, the fund mandate, right? So every fund has a personality of its own, and this fund's personality is being more conservative, being defensive, being very conscious about risk. So largely, it appears to be a fund that tries to mitigate downsides and not as much as focusing on capturing upsides at any cost. So that's why we call it more defensive. So the fund mandate itself is downside protection oriented, and by those standards, the fund returns have been pretty decent. Of course, it is an underperformer relative to peers, but on an absolute basis, it has been doing the risk management job pretty well. A very important element that really dragged the performance is its very high exposure to debt, right? So almost a quarter of the portfolio was held in debt. Now, this comes in at a time where there were clearly selective plays in equity, as we discussed for several other funds. There were pocket of opportunities that did well, so they did not, utilize that as much. Another surprising thing is, although a multi-asset fund offers the mandate offers the flexibility to take commodity exposure, they were relatively underinvested in gold and silver versus the rest of the industry. So this was during a time where gold and silver propped up returns for the entire multi-asset category,
Okay.
and they conveniently missed out because of the debt allocation.
Got it. That did not do what equities did in that period. But thank you so much, Nirav. Always a pleasure speaking with you. Thank you for joining us with your analysis and thoughts on individual names. And have a great new year. We are very close to that, so wishing you that in advance already. Thanks a lot to the viewers for tuning in as well. But we will take your leave. Stay tuned for Closing Bell to take you through the last hour of trade.